Welcome to Upticks. I'm Jake Falcon, the founder of Falcon Wealth Advisors and your host of Upticks. Today is episode 176, Managing Your Company Stock. Thank you for joining me back on the show. Hope all of you out there are staying safe and healthy during this horrible pandemic. For today's topic, I wanted to discuss how to manage your company's stock. And more specifically, I wanted to talk to people that work at publicly traded companies. For many, private companies also have company stock. However, that would be a topic for a whole nother show. And in many of those instances, that private stock has quirky or unique rules that are specific to that company. So again, a little bit more unique and bespoke solution when you're dealing with private stock. For today's topic, I want to talk if you work at a company and your company stock is traded on the New York Stock Exchange, right? Or it's public. Other people can buy and sell it out there. And it's a great opportunity for many people because usually employers will offer company stock as an incentive or a reward for employees that help make the company more profitable. So it can be a very lucrative opportunity. We've seen people's retirements set up far better because they've worked at publicly traded companies, because they've benefited from stock appreciation over many, many, many years. But I wanted to talk about how to manage that because I think a lot of people lose sight of that. Certainly, if you're busy in your career and you're not paying attention to it, it's something that can get away from you and potentially harm you more than it's doing good for you. So first off, in the financial advice business, a broad rule for many advisors that they give to their clients is to not have more than 20% of your retirement in anyone's stock, regardless if it's your employer's, or you inherited it, or it's your mother's, grandpa's, sister's, brother's, friend's company. As a general rule, you can have more than 20%. However, if you do, you have to understand the risk that you're taking. And there are ways that I'm going to go over here in a moment to protect some of that risk. So simply put, if you have $1 million in your 401k, and maybe that's all that you have for your retirement currently, you want to watch it. And once you get over $200,000 in that company stock, so that would be 20% of your retirement, you want to start talking with a fiduciary advisor such as us at Falcon Wealth Advisors, because you want to be careful, because you want to see, and what we can do for our clients is we want to see what if that company stock went to zero. And now instead of having $1 million, you have 800,000 in your 401k. What does that ultimately do to your retirement plan? And that's what you want to be careful of, right? Because if you have the flip of that, let's say you have 80% in your company stock and you have $1 million and you have $800,000 in one stock, what happens if that goes to zero, right? So that's what you want to be cognizant of, and that's what you want to be aware of. I'm not necessarily telling you to go out and run and sell your stock right now, but there are things you can do to protect yourself. But like I said, I'm going to go over here in a moment. So Jen, again, an easy thing is just take a look at, and you might have IRAs, Roth IRAs, your spouse may work. So I'm talking about your overall retirement nest egg. You don't want to put more than 20% typically in any one stock. Just like, and my business partner, Corey, says this all the time, it's just like if a new client's coming to us with $1 million in cash, they would probably look at us, I hope they would look at us like we're crazy if I said, Mr. and Mrs. Client, I'm going to put 20% of your nest egg in one company. I mean, I would assume a lot of people would probably feel a little nervous about that. And it's the same thing. What happens is oftentimes we drink the company Kool-Aid and we don't worry about that because we're working there. We feel like we've got firm control over that stock's valuation, which ultimately you don't. And we're okay taking on too much risk or exposing ourselves. So what can you do? So let's say you say, okay, Jake, that's fine and dandy. I hear you loud and clear. But I don't want to sell my company stock right now for multiple reasons. I'll give you a good reason not to sell it in your 401k here in a moment. But what are some things that you can do to protect it. And one is just being diversified outside of your company. So again, if you have an IRA or Roth IRA or your spouse works, it's building up a nest egg outside of that company plan, outside of that company stock to offset some of that exposure. And then another more advanced, and again, this is a big disclosure, a more advanced strategy that we like to deploy for our clients are trading options. And options is basically a whole separate marketplace that's traded in Chicago. So instead of the New York Stock Exchange, it's traded on the Chicago Board of Options Exchange. And these are basically contracts that you can do to lock in certain price limits for your stock, right? And you have to pay a premium if you want to have that protection. But there's certainly things that you can do to limit the downside of that. And again, that's a topic for a whole nother show. A big disclosure here, though, there are risks with options. And so that's something that you definitely don't want to go at alone. We at Falcon Wealth Advisors, we trade a ton of options for our clients. So we are familiar with that strategy and in that world. So again, if you are curious to learn more about it, I think it's more important to have a one-on-one conversation about your specific situation than me just throw out blanket statements about options. Because again, there's puts and calls. You can be long and short. You can do puts and calls. So again, there's all these different strategies that you can do with options. And you have to be careful because you have to have a firm understanding of exactly what you're protecting and what you're risking to protect that. But again, that's something that we certainly do a lot of at Falcon Wealth Advisors. And if you're interested, please don't hesitate to reach out to me and we can have a one-on-one conversation. Now, a big reason, though, that a lot of our clients don't start selling their company stock, particularly in their 401k, is that they may be subject to a favorable tax treatment called net unrealized appreciation. And the way this works, and we'll use my $1 million example. Let's say you said, all right, Jake, I'm not going to listen to you. I'm going to keep $1 million in company stock because I'm retiring next week. The stock price is high. I'm going to sell it then when I retire. All is well. I got lucky and it all worked out. Well, what net unrealized appreciation says, if you have $1 million in company stock, and let's say in your 401k, and let's say that your cost basis is only $100,000, meaning the average price that you paid over all these years, which again, the 401k plan should have and provide you, is $100,000. Well, if and when you go to retire, and again, there's other rules that are subject, but it just again, in this generic example, if you leave the company and you empty out that 401k, you can take that $100,000 cost basis, and that will be treated as ordinary income to you in the year that you exercise this. However, the $900,000 gain will be subject to long-term capital gains, which currently, for many of our clients, is a far lower rate than their ordinary income rate. So $100,000, they'll have to pay it, 30% plus taxes, but that long-term capital gains will only be at 15 or 20%. So, and again, this very generic example, that delta of 30% tax rate versus 20% tax rate is what they save in taxes. So it could be literally thousands and thousands and thousands of dollars that you save from this net unrealized appreciation. Now, again, this is a somewhat complicated transaction. You definitely want to get your CPA involved. Us at Falcon Wealth Advisors, we do it a lot. So we're very familiar with the tax planning side, but you want to work with a competent CPA that can file this correctly, because again, if they don't, it may mess up the whole strategy. All right, but that's a reason that a lot of people keep their nest egg overexposed. So again, ways you can protect yourself are through options or diversifying outside of your plan, in other investment vehicles or through your spouse's plan or something else. Now, before I go over managing restricted stock units, stock options, associate stock purchase plans, I want to give a quick plug as a commercial here. So again, thank you so much for tuning in. I'm very humbled. Our YouTube subscriber count continues to grow. Thank you so much. If you think our content's good, please feel free to give a thumbs up. Also, my business partner, Corey Bittner, has his own show right here on YouTube called In the Money Insight on our same channel. If you're listening to this on your favorite podcast platform, thank you so much for listening. Again, a thumbs up or a 5-star rating would be greatly appreciated. And the best way to make sure you don't miss another episode of Upticks is to simply subscribe. Also, my company, Falcon Wealth Advisors, we've been very humbled, continues to grow. We've actually signed up around 200 clients during the COVID era here. And so our team continues to grow. We're out there on social media. So we're on Facebook, Instagram, Twitter, and LinkedIn. If you're not connected with our company, I highly encourage you to do so. And me, Jake Falcon, I'm personally on the same 4 platforms. So if we're not already friends, please send me a friend request, and I'm happy to grow my network. Okay, so leading into the second half of the show here is how do you manage associate stock purchase plans, stock options, restricted stock units, all these different equity compensation packages or benefit packages that companies have. And the best way I can tell you to manage it is to build out a financial plan with a fiduciary. Again, this is very important, a fiduciary wealth advisor. And what do I mean by that? Well, a fiduciary wealth advisor is simply charged with only acting in your best interest. And believe it or not all advisors are the same. Not all advisors are fiduciaries. And some advisors even try to be both a fiduciary and a broker. And you want to be very careful of that too, because I think that makes it even more confusing for the client. So again, you want to work with an advisor. And the reason is because if you're working with somebody who is not legally obligated to only act in your best interest, they may give you advice that can be perfectly suitable, but might not necessarily be what's best for you. It might actually be a little bit better for the quote unquote advisor in the situation because they can charge you commissions or make money off of it. So there's some conflicts there that you definitely want to be aware of. But how to manage those RSUs and stock options and associate stock purchase plans is you just want to understand the benefits. Most importantly, incorporate them in a financial plan so that then what we do at Falcon Wealth Advisors, we can run different projections. Well, what if I keep buying through the associate stock purchase plan and I transfer it over and I run options on it from there? Or how are these RSUs as they are granted to me? What's that going to do to my tax situation? Do I need to donate to charities in the years that my RSUs are vested? Stock options, when do I exercise my options? Do I wait for a certain price, or is volatility an issue, or is my retirement more important, right? All of these things are best suited answered upon putting them in a financial plan and then letting us at Falcon Wealth Advisors take a look at your entire picture. And then we can start pinpointing and giving you good advice to say, okay, with your associate stock purchase plan, we recommend you buy this amount. Once they're able to be moved, we're going to sweep them over, move them, and hedge your position through options. Right? Stock options are granted. That's great. We know it's going to be a taxable event if and when you exercise them. So we want to be cognizant of whatever the grant price is, when they expire, and what the trading price is, right? And we coordinate that with your CPA and take into account your tax situation. And then RSUs, as they vest, they're typically taxable. But again, we can see the RSUs coming down the line and the vesting schedule. And then again, coordinate with your CPA to make sure that as those vests and as your income increases, again, a good problem to have, if we need to offset that through a health savings account, maybe bumping up your 401k, donating to charity, other types of vehicles or options available to you to mitigate some of that taxes so that ultimately your financial plan is set up better for retirement. That's what we're here to do. So I've been meeting with a lot of new clients lately. A lot of them have been do-it-yourselfers, and I love that and I welcome that because, again, I love doing this for a living, so I completely understand why someone would do it on their own. But what they're quickly realizing is that it's a full-time job, one. So again, that's why people hire us at Falcon Wealth Advisors, because what we do takes a lot of work, and there's 12 people literally on my team, all working for the same set of clients. And then two, it can be very emotional. If your company is in the middle of a merger or an acquisition, or maybe you just got granted 5,000 shares and you don't know what to do because it's also overwhelming, let a third party come in and help you and look at the numbers and help you make some unemotional decisions that are going to set up you and your family for a better retirement plan. Okay, good. So that's all the time that I do have for you today. I will leave you with my overarching motto or theme at Falcon Wealth Advisors is that clients ultimately choose to work with us to enhance their financial literacy. So props to you for tuning in to today's episode and explain exactly what their financial plan means to them. And again, that's what's so important. It's about you and your financial plan. In my opinion, it pays to work with a fiduciary-minded wealth advisor. And so if you're not currently working with us at Falcon Wealth Advisors and you would like to set up a time to meet, please don't hesitate. My email is simply jake@falconwealthadvisors.com. You can send me an email. I'm happy to share my calendar with you, and we can set up a time to talk. If you are currently working with us, thank you so much for your trust. We look forward to continue to build out our team so that we can continue to serve our amazing clients. And if you are working with us and know someone that could benefit from our services, please don't keep us a secret. We are open for business, and we are still accepting new clients by referral and invitation only. With that, I'll leave you guys. Hope you had a great holiday season. I'm excited for 2022. I plan on bringing more guests on Upticks for 2022. So if you have any ideas, if you'd like to be on the show, feel free, send me an email. I'd love to have you on the show. I just want to bring more professionals on, more people that I think my clients could benefit from hearing their stories. So I'm excited to start rolling those out as we enter the new year here. Thank you again, and hope all of you have a great week.